Total Return webcast. As always, the title has some meaning to it. It's called Looking Backward. And Looking Backward, it was an incredibly successful novel. It was written in 1888, or published first in 1888. It was written by a fellow named Edward Bellamy. And the book contemplates a utopian society by the year 2000. So the actual full title of the book is Looking Backward, 2000 to 1887. It was the third largest bestseller of its time. It influenced many intellectuals and appears by title in many socialist writings of the day back in the late 19th century. It created almost immediately on its appearance a political mass movement. In the United States alone, over 162 Bellamy clubs, named after the author, of course, sprang up to discuss and propagate the book's ideas. Owing to its commitment to the nationalization of all private property and the desire to avoid the use of the term socialism, this political movement came to be known as nationalism and inspired several utopian communities. The decades of the 1870s and 1880s were marked by economic and social turmoil. American capitalism's tendency towards concentration into ever larger and less competitive forms, such as monopolies, oligopolies, and trusts, began to make itself evident, while immigration from Europe expanded the labor pool and caused wages to stagnate. Of course, I'm reading this and highlighting some key points, and I would hope the audience would understand that I'm comparing the environment in which this novel was written and published to great success resembles a lot of the societal situation that we're in today. The time was ripe for new ideas about economic development, which might ameliorate the social disorder. Bellamy's futuristic novel met with enormous popular success, with almost 500,000 copies sold in the United States alone in under 10 years. And of course, that's in the context of a much lower population than we have today. Looking Backward tells the story of a hero figure who, towards the end of the 19th century, falls into a deep hypnosis-induced sleep and wakes up 113 years later. He finds himself in the same location, which was Boston, but in a totally changed world. It is the year 2000 when he wakes up, and while he was sleeping, the United States has been transformed into a socialist utopia. The hero figure readily finds a guide who shows him around and explains all the advances of the new age, including drastically reduced working hours for people and almost instantaneous internet-like delivery of goods. Everyone retires with full benefits at age 45 and may eat in any of the public kitchens. Productive capacity of the United States is nationally owned, and the goods of society are equally distributed to its citizens. Although Bellamy's novel did not discuss technology or the economy in detail, the hero figure is taken to a store which rather closely resembles a modern warehouse club that we find today. He additionally introduces, Bellamy does, the concept of credit cards. All citizens receive an equal amount of credit. Looking backward, it stoles an America in which the nation is the sole employer and capitalist. Now, I found an article on the internet from the New York Times written on the 100th anniversary of the publishing of Looking Backward in 1888. And I would really recommend, in 1988 rather, the New York Times article, I'd highly recommend it to anybody who wants to learn more of this, not only because there's a lot more than I have time for today, but also it's fascinating to see the attitude, the editorial attitude of the New York Times regarding socialism and this utopian idea in this book, because it's 180 degrees the opposite of the editorial voice that one finds in the New York Times today. I'll read a brief amount of excerpts and then we'll be on our way. New York Times says, "We are still reading his durable classic, but time has revealed to us what it hid from him, the appalling implications of his prophecies. In hindsight, it appears that the novel could not have been more perfectly timed. America had become volatile. Enormous trusts were fixing prices and controlling whole industries. Big city bosses were inventing the modern system of graft. Anarchists were cooking dynamite in tenement kitchens. By the end of 1891, the sales of Looking Backward had approached 500,000 copies, making it the biggest bestseller of all time. It imagines the year 2000, in which the state manages all industrial activity and provides jobs for everyone. People retire at the age of 45 and spend the rest of their lives in leisure. Harmony between the sexes has become perfect. Everyone is educated and intelligent. Public spirit has overcome selfishness, All the people share the wealth equally and want for nothing in society, free of the conflicts that characterize all previous human history. Capitalism, it is explained, had continued to swallow competition and bigger trusts until it consolidated itself into a final monopoly. The government intervened to absorb all enterprise in the great trust, the all-embracing industrial giant of the state. This formation of one great business corporation occurred absolutely without violence. So think about this as we go through some of the slides. We'll be looking backward over the past year. Interestingly, today, March 9th, the pandemic, I believe, was announced or recognized as a pandemic, I think about a year ago this week. Maybe it was March 11th, if memory serves. Also, interestingly, as this is March 9th, the low in bond yields for the 30-year Treasury was hit exactly 1 year ago today. So the total return of the 30-year Treasury, actually the price return, I'm not including the puny coupon of 1%, you can do the math. The 30-year Treasury bond return is on TLT, so this is the 20-year plus ETF, is negative 18.1 for the past 12 months and negative 11.5 year to date. So pretty negative duration effects for these longer duration indices, as we've warned about, would be the case as rates started year to date. Kind of quietly surprising with significant negative return. Last 12-month, the price is up 2.1. The Lehman Aggregate Index, fascinatingly, on price is down 3.7% both year to date and over the last 12 months. Exactly the same. So a very strong outperformance on a year-to-date basis as we have had since the summer. Here's an interesting slide. I used this a couple times last summer. It shows some of the disconnects between GDP, employment, and the S&P 500 market cap. What we have is, let me see, I'm trying to adjust this slide. It's not reading properly. Bear with me a moment. I'm not sure what's, okay, now it's reset properly. Apologize for that. So if you look at this, we'll notice that the most recent data point when this exhibit was created, which was at year end, was third quarter nominal GDP, and technology represents 6% contribution to nominal GDP. And then we see that technology represents only 2% of all the employment in the sectors of the S&P 500, and yet technology at year end represented 38% of the S&P 500's market cap. So talk about large corporations, quasi-monopolies or true monopolies, taking a large share of wealth while not benefiting very much the employment of society. Sounds a lot like looking backward. So let's see what happened in the last 12 months, economically speaking. Still having trouble getting this to preset properly. I apologize. I'm only getting a partial slide on my screen. I'm just going to, I hope the audience can see these slides. So what we say is the GDP was growing at about a 2.5% trend line, 2.5% trend line growth, and then the pandemic hit, and we see the massive decay in GDP. I've been quoted in the global media with my own idea that we're still in a recession. I know that seems weird with GDP now up around 9% or so for the first quarter, but I'm looking at the gray line here. And Gundlach's rule of economic recession/growth is you're not out of the recession until you get fully recovered in terms of nominal and real GDP. And we're not there yet. We still have a pretty big gap in spite of all the government's efforts. Of course, the Fed did a lot of work here with expansion of its balance sheet. We've talked about this in the past. They're back at it again, buying something like $100 billion or so per month, maybe $120 billion or so per month. Of course, that's necessary because of all of the economic programs that have been rolled out. Interestingly, the stimulus so far has been $6.1 trillion from the federal government alone. That compares to $1.8 trillion back in the global financial crisis response, labeled here the Great Recession. So we're something like triple, more than triple the stimulus, and there's more coming, of course, as the administration and the democratically controlled Congress seem very interested in another multi-trillion-dollar spending program, this time at least discussed as being related to infrastructure. Of course, a lot of weird things happen when you get this type of government manipulation of the economy. One of the weirdest things that happened is the incredible volatility in savings as a percentage of disposable income on the screen right now, which has been wildly volatile. I've been talking about investors and economists should be expecting incredible volatility by any historical standards. Certainly, we've seen that in personal income and spending data and GDP. The next slide is personal income, percentage of personal income made up by government transfer payments. And so we see that it used to be back in the 60s, down at about 6%, and then it went to 12% in the 80s, and then it went to 18% in response to global financial crisis. And we hit a peak recently of 32%. That quieted down when the stimulus was put on hold for a while, but now we're back, and we're back up to about 28%, and it's probably going to go higher, of all personal income is made up by transfer payments. So we're getting ever closer to that looking backward sort of situation, although there's some ways to go. Here we can see what's something that's benefited from all of this stimulus, and it's actually our trading partners are benefiting. On the screen now is U.S. Current account trade balance, and of course we've been in deficit forever on this exhibit going back to 1995. It was gradually improving. The trade deficit was shrinking there for a couple of years, but then we did the stimulus, and where did it go? Well, it appears it went to our trading partners, because we've seen about a 1.5% increase in the trade deficit over time. Who else might have benefited from this more specifically? Well, maybe it's China. This slide is freight container rates going from Hong Kong to Los Angeles. And you see that once the stimulus started about a year ago, they went through the roof, gone from about 1,500 reading to 400% of that at 6,000. So it's pretty clear that our stimulus is benefiting our trading partners. Seems like with the direction of the trade deficit, it seems to be benefiting them more than us. Of course, I've talked about in the past how the budget deficit has been exploding. I'm changing laptops here so I can see the slides better. We apologize. Okay, so here's the budget deficit watch I've been talking about. And of course, the budget deficit has totally exploded. It shows at 16% of GDP. It's actually higher than that, as I've always talked about. The budget deficit is understated by about a 1.4 trillion for the year 2020 because they don't count some of the what are perceived to be one-off things. So for the last 12 months, the government has spent about $8.1 trillion. 4.6 of that spending, or 54% or so, if memory serves, is borrowed money. That's projected. You can go to debtclock.org and fast forward 4 years. It's predicted by debtclock.org that the current rates, we will have 70% of government spending in fiscal 2024 be borrowed money. Makes one wonder, and usually these things end up being worse than forecast. So let's imagine a world where 4 years from now, 80% of the government's budget at the federal level is borrowed money. Makes you wonder why we have taxes at all. If you're going to help only collect 20% of your budget, why bother with all that machinery? Of course, there are vested interests in the IRS and in the legal profession and the accounting profession that would be unnecessary if there were no taxation, but that's the road that we've been headed on. Here's the dollar, and I'm not going to dwell on the dollar here. I've got this chart. I've been positive on the dollar for a few months now, although my long-term view, as I've stated unequivocally in the past, is that the dollar next move is going down. We see that we held that horizontal black line, which is in the very high 80s on the Dixie index. And now we see that we have bounced off of that horizontal line. We were up at around 92 yesterday. I think the dollar's down a little bit today. But we have been looking for a dollar bounce, and it looks like it has started. One of the things that made us anticipate a dollar bounce is this dollar wedge. We're zooming in here over the past year, and we see that we had a pretty classical wedge pattern. And when we broke to the upside, which was pretty much where some of the important moving averages were, we started higher. So I think in the near term, the dollar can continue to appreciate a little bit, but the big long-term view is correlated with the growth in the deficit, both trade and budget. the long-term trend of the dollar seems very likely to be lower. Here we see the unemployment rate, which people talk a lot about because if you want to be a rose-colored glasses type of economist, you're happy that the unemployment rate is back down to 6.2%, having been up there at about 15% or so. But of course, there's a big mix shift problem here, because with all of these government programs, a lot of people that are being counted as employed aren't really employed. What we like to look at DoubleLine is this chart, which is continuing claims for unemployment insurance benefits. And you'll see that it's broken down into 4 categories now: extended benefits and federal employees. There's the legend doesn't really fully read. There's these different government programs, and the point I'm making is that we haven't shrunk anywhere close the percentage here as was reflected. I'll go back on the prior slide where it looks like we're almost back to sort of like 2008 levels. Here we see that we haven't anywhere near shrunk back. So this is really what's going on in the economy. We still have 18 million people who are in various forms receiving continuing claims for unemployment insurance benefits. 18 million, that's over 10% of the labor force. So the 6.2 is kind of a phony number that we get the first Friday of every month. And you can see that consumers think it's phony too. Consumer confidence hasn't bounced back at all. Consumer confidence dropped off a cliff, of course, with the lockdowns, and hasn't rebounded net at all. So those 2 charts, I think, the previous one and this consumer confidence chart, show that the consumer is far from fully recovered and is not at all in back to January of 2020. Here's an interesting chart. It's the S&P 500 performance relative to MSCI Europe. And as I've been talking about this for quite a while now, this trend has stopped being negative for Europe. We see that the S&P 500 has actually stopped outperforming. In fact, since the summer, it started to marginally underperform. And that's pretty important. What we see here is a pennant formations, at what we call it, where we seem to be coiling in an ever-narrowing range. I'm not making a prediction here that Europe's about to go on a near-term performance trend. And I don't think it's wise to make such predictions. I think when you get a chart that looks like this, you just want to go with it. If the S&P 500 starts outperforming again and breaks above this pennant, you want to stay with the S&P. If it breaks to the downside, which is, if I were forced to bet, that's what I would expect, then Europe will start outperforming. And of course, there's a long way to go in terms of correcting the tremendous S&P outperformance, where there was an outperformance there of hundreds and hundreds of basis points, if not thousands of basis points. Something I've been talking about is how the high beta stocks have been such high flyers. I've called them the Super Six. Of course, they've stopped outperforming, and one by one, we're starting to see some casualties occurring in some of the mega cap names. But high beta, of course, went absolutely vertical with the pandemic, and it's really amazing how high these stocks are valued relative to pre-pandemic, where you went from 15,000 all the way up to 23,000. So basically, a very substantial. It's not even parabolic, a linear rise. It's beyond parabolic. And so, of course, equity flows had a lot to do with this. These are global equity flows with just unheard of global equity flows on a 16-week cumulative, which is what this chart displays. So this is the fuel that has been poured into global stock markets, and ergo the remarkable recoveries in particularly the United States. Here's the PE ratios that are a consequence of this high-flying situation. We see the actual PE ratio now, and of course, its earnings are very likely to improve. So this is a trailing PE ratio, the red line, but we can say that it is basically the highest of all time. And then you can go to a prediction of a forward PE ratio with some forecast of earnings for the next 12 months, and it's just really high. It's not as high as 1999, but it's very elevated at about 19. And I keep telling people, remember, President Biden has campaigned on raising corporate income taxes back up to about 28%. That would mean that the PE ratios, of course, after the effect of those tax increases, these PE ratios would have to be adjusted even higher should that legislation take place. Here's the CAPE ratio, Dr. Schiller, and as that we said in the introduction, there's a video up on Roundtable Prime for Equities with Dr. Schiller, and we point out how high the Schiller CAPE ratio is above 1929, well above 07 and other peaks, not as high as the dot-com bubble, but certainly no one will say that a CAPE ratio of 35 is cheap. Here's the S&P as a percentage of nominal GDP, and it's an all-time record. So relative to the size of the economy, the stock market has never been bigger. Therefore, one could say perhaps not, it's never been more overvalued. This is just fascinating. I won't spend a lot of time on this. We've been following the return to pre-COVID economic data. What we see here is that hotel occupancy rates are still pretty depressed. They're lower than 2009. They're way lower than 2020. We'll see what happens once we get to a different year-over-year comparison so that we're not starting pre-pandemic as we are in this exhibit, but not even close to returning. And yet look what's happened to travel and leisure stocks. I find this to be really fascinating because, yeah, there might be some pent-up demand. I know they're going to be opening Disneyland up, for example, to 20% capacity in about a week. And there'll probably be some pent-up demand for things, but seriously, to be 20% higher in value for travel and leisure ETF TNL, which is a great name, TNL for travel and leisure, we're up 20% roughly above pre-pandemic levels, and that seems really almost inconceivable to me. Here's the incredible round trip of mega cap versus micro cap. We talked about this a lot in the summer, that it was the time to rotate into small caps out of large caps. We reiterated that very powerfully in September in the DoubleLine Total Return webcast of September. And now we see that we accomplished the entire round trip, the whole outperformance of mega cap ETF DIA from 2014 into the peak of last summer, a massive outperformance. It all got reversed in a few months. And so all the way back down. So it would seem that this trend probably has gone very far, very quickly. Not surprised to see the mega caps bounce a little bit more recently, but incredible volatility here as we've been expecting and continue to expect. It is my belief, and I've said this on Charles Payne's show that I did probably a month ago or so, I expect that the VIX will hit its highest ever level when we get into the next teeth of market correction or bear market. And I think the VIX will go over 100 during the next downturn in markets, which from these lofty valuation levels and with the amateur aspect of the market with Robinhood, and there was a survey from, I think it was Deutsche Bank, if I'm wrong, I apologize, but they were asked investors, what are you going to do with your $1,400? Not investors, citizens. They asked people, what are you going to do with your $1,400? And remarkable percentages said they were going to put it into the stock market. So we'll see if they follow through on that. In some categories, even low-income people had something like 20 to 25% of their check. They were thinking of putting it into the stock market. Nasdaq looks pretty dicey here. One thing that I look for a lot in markets are when you have a double top, where you go all the way back to a previous level. Here at the Nasdaq, well, the S&P took out the incredible overvaluation of late 1999, early 2000. So the Nasdaq round trip all the way back, and now we see what we call a throwover. It's not totally convincing yet, but look at the Nasdaq, how it briefly took out the past peak of the dot-com bubble and now has rejected that peak. So the Nasdaq certainly has been performing strangely. There are many days when the Dow Jones Industrials are up and the Nasdaq is down. There was a massive one just yesterday, I believe, but now we have the Nasdaq has recovered very sharply today. So we'll have to wait and see. But this is not predictive, in my opinion, of the Nasdaq continuing to outperform. Just the opposite, as we saw in the drawdown from 2000 into 2003 or so. Commodities, this is fascinating. Commodities, I've showed this chart before, and it's just remarkable. Commodities are the blue line on here, and this is the total return of a Bloomberg Commodity Index. And the red line is the S&P 500 cumulative total return. And it's amazing how similar they were for the 10 years or a little bit more than that, from 1995 or so into, say, 2010, so call it 15 years. And then all of a sudden, QE became a permanent fixture, and the S&P 500 left commodities in the dust. It seems pretty clear that the quantitative easing program helped the financial assets and not real assets, like in looking backward, where the monopolist economy was helping the robber barons, but it wasn't helping as wages were stagnant thanks to immigration from Europe. This time we don't have immigration from Europe, but we have immigration from other places, and there certainly has been pushback in the prior administration from the types of immigration policies that allowed wages to stagnate in the United States for so many years. So commodities have started to perform. It doesn't look like much because the scale here is so incredibly big, but fascinating that QE seems to be the driver of the relative performance of real versus financial assets. Here's the Bloomberg Commodity Index, longer term, going back to 1990, and we've broken a pretty steep downtrend. And I would be quite bullish. I am bullish on commodities, particularly longer term, because I'm very negative on the dollar. Longer term, not in the near term, where I'm more neutral, but longer term. If commodities index here breaks above 90, it'll start to look like there's a lot of headroom for commodity prices to increase. So watch for that if the dollar continues to soften longer term. So, of course, inverse US dollar versus commodities, no surprise here. When the dollar goes down, which is the red line going up, means the dollar is going down. Obviously, that's because applied inversely. Commodities are very highly correlated to dollar weakness. Interestingly, the dollar had strengthened a little bit recently, as we expected, but commodities still remain pretty much at a local high. The dollar increase hasn't been significant enough. Here's the US core CPI year over year, and it really is stable, has been stable for a long time. It's down to 1.4 now. So there really isn't any inflation in the core CPI, but we do expect a very significant increase in headline inflation in the next few months, due to a significant extent to the base effects of a year ago's very soft economy and soft commodity prices and pricing power generally in the early stages of the lockdown. But we do expect that inflation on the headline CPI will be above 3% for a couple of months on a year-over-year basis come June, July of this year. The Fed has been talking about that. They're aware of these base effects, and they're trying to telegraph to the bond market that the Fed chooses to be unconcerned about a period of time with inflation running above 3%. In my opinion, not only are they unconcerned, they welcome inflation being higher than interest rates. They like negative real interest rates because they know that negative real interest rates help to forestall the incredible deficit and unfunded liability problems the United States has. We'll cross very shortly above $160 trillion of unfunded liabilities in the United States, virtually 800% of GDP. Clearly, that cannot be paid back in today's purchasing power dollars. Either we need to consolidate those unfunded liabilities, i.e. default on some of them, or restructure them, to put it more politely, or else we need to debase them. Here's ISM prices paid with a 4-month lead to the CPI year over year. It's kind of noisy, but the blue line is ISM prices, and it's leading the red line by 4 months. So based upon this one variable, one could actually plausibly predict headline CPI could go over 4% at some point in about 4 months from now. That, I think, would really spook the bond market. Bond yields have been rising. Over the past 12 months, the long bond yield is up 125 basis points. As I said earlier, its low was literally 1 year ago today on a closing basis. The 10-year yield is up 101 basis points over the last year. Only the 2-year Treasury on the yield curve and the 3-year Treasury are down. The 2-year Treasury yield is still down 40 basis points from a year ago. Now, of course, it fell pretty quickly, 50 and 51 weeks ago. So there'll be a very different look just a few weeks from now. But right now, the 2-year Treasury, so they down 40 for the last 12 months. So the yield curve from 2s to 30s has really twisted, 40 basis points down over 12 months on the 2-year, 125 basis points up. That's 165 basis points of steepening, which was one of my highest conviction ideas a year ago. It's probably has some room to go there. The real $64,000 question is, what level of long rates will the Fed step in and do what they have said they would do, which would be potential yield curve control. That they might want to do that if the bond market started to react to potentially 4% inflation printing. My guess is bond yields would not be able to stay at 2.25, which is where they are in the 30-year, and 154 where they are right now on the 10-year. So the yield curve has been steepening. Producer price index has shown an incredible increase. Last month, it came out at 1.3 unannualized. Look at the green bars on here. Actually, the producer price index year over year has now swung positive, and what's going to roll off are some of those red bars. So the 12-month year over year PPI, which is that dark line, that's for sure going higher. The most recent 1 month was a real eye popper at a 1.3. Of course, if you annualize that, it would be Jimmy Carter type of inflation. Here's the underlying inflation gauge, which is 16-month lead, has a good fit to core CPI. It's bottomed, and core CPI is probably bottomed as well. So it's not lining up as perfectly as it has historically, but the New York Fed underlying inflation gauge suggests higher core CPI. And as I said, that's what the Fed wants. And the bond market is sensing it too. Now, here's 5-year break-evens. 5-year break-even is pushing 2.5% on the 5-year Treasury. So there's some sense of rising inflation pressure showing up in bond market pricing. But part of that might be due to the fact that the Fed has bought a lot of TIPS, depressing the yield on TIPS. You can see that the Fed didn't used to be involved much in the TIPS market, down at about 9% of the market being held by the Fed, but it's been rising pretty substantially. I think they like the idea of inflation expectations going up. Long-term gold is pretty interesting. Gold went down to a pretty low level yesterday, 1681 on the close. That might be the low in gold for a while. Gold has really underperformed other froth assets like Bitcoin by incredible amounts, almost inconceivable amounts since that peak in gold above 2000. We turned neutral on gold at above 1800. Certainly that looks to have been the right call. At this juncture, I think gold is very likely to bounce because the sell-off has been pretty powerful. Here we have a model that we use, gold and our 10-year real yield implied gold model. This is another thing that DoubleLine has developed, just like the copper-gold ratio for the 10-year, which we'll get to in a moment. And we say that our model actually shows that gold is sort of at fair value at 1761. And when we did this, gold was at 1734, went below 1700 yesterday. It's back up again today. Gold looks like it has fair value using this model a little bit above where the level is today. So we don't think the decline in gold is likely to continue. Some of these measures on the 10-year Treasury are interesting. Here's one I haven't used in a long time. It's the mean of the 7-year average of nominal US GDP with the German 10-year yield. This one actually shows that the 10-year is just fine at about 1.5%. It shows that this long-term fair value using GDP and the German 10-year, this does not show substantial upward pressure on the 10-year, but it's one of the only metrics that reads that way. Here's the 10-year U.S. Treasury yield and CPI rolling 10 years. This also shows that the 10-year is not that overvalued, yet the CPI could very likely start to, this is a long 10-year growth rate CPI, it's a long term, but since we're probably going to be pushing above the 10-year average or where the inflation was 10 years ago, this would probably put modest upward pressure on 10-year yields. Some other indicators are nowhere near as copacetic. Our old friend, the copper-gold ratio, which I just referenced, says that the fair value on the 10-year Treasury as of a week ago was 2.86%. Let's just call that 3% using the copper-gold ratio because gold actually went a little bit further down in the last several days. So this shows that the yield on the 10-year should be 150 basis points roughly higher than it is today. Perhaps the fear of the Fed suppressing it is keeping this gap ever widening. Here we see copper gold versus the 10-year yield. Zooming in a little bit, this suggests that the 10-year Treasury yield should be, again, closer to 3%. Here's commodities and interest rates. Pretty big divergence. It was a lot bigger a few months ago, but here we see that commodities have gone way up, a huge increase in commodity prices, and the 10-year Treasury has risen in sympathy, but certainly looks overvalued at today's yield versus the move up in commodity prices. Here's the Fed's balance sheet and the slope of the yield curve. I'm using 3 months to 10 years. It's sort of uncanny, isn't it? That when the Fed is doing the quantitative tightening, we see the flattening of the yield curve, and then we see the Fed starts to reverse course and goes back to increasing its balance sheet, and the yield curve almost to the day starts to steepen, and it gets ahead of the Fed. So the curve flattens back down, and then the curve really steepened, and that got the Fed really in gear in quantitative easing, and they've started it again. So there's a strong correlation, which is counterintuitive to a lot of people, that the Fed quantitative tightening led to a flatter curve, and the quantitative easing led to a steeper curve, but it's actually because the Fed gets overwhelmed by the market action and starts to have to respect what the market is saying, I think, and get in gear with it. Here's the PMI, manufacturing and the 10-year yield. There's something of a correlation here, not surprisingly. Yields tend to fall when you have contractions in manufacturing activity and vice versa. When you have expansion of manufacturing activity, this has a lot of tracking error, if you want to call it that, but it does move in the same direction, and would certainly suggest that we would expect the 10-year Treasury yield to be at least 3% based upon the PMI correlation. Now, one thing about the bond market, it looks overvalued versus inflation. It looks overvalued versus copper, gold, and PMI, and some other things, but it's really oversold. The bond market, the 30-year Treasury drawdown got down to one of the biggest drawdowns in history on this display, going back to 1987. Not quite as low as it got in 2008 on the drawdown, or 2009, I think it was, after the massive rally of 2008, but pretty oversold on 30-year Treasury. The drawdown, I showed you the TLT drawdown, at least I vocalized it. It was 18.5% for the last 12 months. The actual drawdown in the 30-year is a full 25%, and you had all of a 1% coupon annualized to buffer that, to cushion it. So really a bloodbath going on at the long end of the yield curve, not surprisingly, but it's really oversold. Here's the Treasury bond sentiment. It's about as bearish as you're going to see. Now, sometimes bearish sentiment gets worked off with sideways movements, and that's sort of been the case in the last few weeks. We've had sort of sideways movement at the long end. From this oversold, I would expect actually in the near term a modest or moderate decline in yields at the long end, because this is pretty far ahead of itself or it's pretty overextended sentiment-wise. Been a real different attitude in fund flows from the Treasury bond market, which is the gray diamonds, and the blue diamonds, which are the investment-grade corporate bond market, where we've seen inflows of, it's almost like they took the money out of treasuries, because 15 billion went out of treasuries and went into corporates. It's almost like that investors have done a swap. If they did, it was a pretty bad idea, because as I pointed out earlier, the duration of corporates has caused significant negative returns year to date, and they're worse than treasury returns because their duration is longer. The spreads haven't really changed that much. Everything so far in 2021 has been about duration. Spreads have moved around modestly, but pretty much you're succeeding with a lower duration, and you're failing with a longer duration, both in treasuries and other markets. Of course, treasuries continue to sell treasury bonds. Foreigners continue to sell treasury bonds. The only buyer in the past couple of years has been the Federal Reserve. Foreign holders have accelerated their liquidation, and domestic holders have not been buying. This is what's caused some of the problems with illiquidity in even the treasury market or even the overnight markets, because there is a lack of robust and normal organic demand. Here's that 7-year auction that got so much attention a couple of weeks ago. It was one of the worst 7-year auctions in history. One of the reasons was that foreigners retreated from their buying. Actually, the arrow was pointing to the wrong thing. The arrow is supposed to be pointing to the black line, which is indirect bidders, which are interpreted to be foreigners. So there was zero foreign demand relative to history, for recent history, for the 7-year auction. That's consistent with the preceding slide. Just pointing out, the yield curve moves quickly when it moves. It flattens quickly and it steepens even quicker historically. And this time it's no exception. We bottomed out. We usually bottom out 2s to 10s at around 0. Small inversions happen. And then once it gets in gear on the upside, it can go up 250 basis points. If it goes to the 250 today, with the Fed still anchoring the short end, with the 2-year at 16 basis points today, well, that would mean that we would see the 10-year go up under historical comparisons to about 265 or so, maybe 3%. These trends are powerful. This one is totally convincing at this point. Again, the real question is, how steep will the Fed allow this to get? Corporate bonds remain at modest, really modest, 1 basis point negative real yield in corporate bonds. So corporations can borrow lower at the same as the CPI, basically. As the CPI goes up, the corporate bond yield, if it stays the same, will go more negative. We'll see if that happens. Corporate bonds don't yield a lot. Junk bonds to no losses yield less than 4%. There's a significant fraction now of the high yield, so-called high yield bond market that yields less than 4%. I think it's more than half the market. We see BBB corporate yields are now virtually identical to 30-year Treasury yields. So pick your poison. The 30-year Treasury has had a massive drawdown because it has obviously a very long duration. Corporate bonds have a duration of about 8.25. The LQD ETF, just FYI, has a duration of about 10. So it's longer than the investment grade corporate bond market. Ergo, it's had worse returns than the corporate bond index year to date because it has a longer duration. But pick your poison. Different risks. BBB corporates have significant default risk or downgrade risk, but they have half the duration of 30-year Treasuries. 30-year Treasuries give you the same yield, but you have other problems, obviously, with interest rate risk. One thing good about the high yield bond market and the corporate bond market broadly is the downgrade cycle appears to have bottomed out and sort of at the same level as the last 2 recessionary periods. So we're starting to see a little bit relaxation in the dominance of downgrades over upgrades. It's at a pretty low level. We think this, with all the stimulus that's going on and all of the largesse that's going on regarding payback of credit, both in the consumer economy and with lifelines that have been extended repeatedly to various parts of the corporate economy, this upgrade cycle has probably started to get underway. I recommended bank loans as one of my favorite fixed income sector on a standalone basis in my Just Market webcast. That has been one of the better performing sectors. The BKLN has generated a 40 basis point price loss year to date, and has had a gain over the past 12 months, but a 40 basis point price loss has probably been offset almost exactly by the coupon. So capital preservation has been afforded in the bank loan market. We also see that retail flows were really outflow. That black line or the dark line is incredible outflows from the bank loan sector. That typically reverses when U.S. Treasury yields go up, and since we've been expecting that, we're not surprised that bank loans have started to experience inflows, helping to support their price. A couple more charts, then we're going to turn it over to Andrew to talk about some of the specifics of the underlying asset allocation sectors. And then I'll be back for a little bit of Q&A. I know this is going to go a little long, but I'll like last time, I think I'll summarize the questions and answer 3 or 5 of them that seem to carry the main themes that are in the queue. So here's the amazing recovery of loan prices. The S&P leveraged loan prices, and we do these by letter rating. You see how weak the low tier was. The single Bs went from went all the way down to 75 cents on the dollar, and now they've fully recovered. You can see that every credit slice of bank loans on a price basis is pretty much fully recovered, and even more than fully recovered in a couple cases to pre-COVID levels. We appreciate your support, and we look forward to driving the car through the rough road that awaits us in the next several years. Thank you for support of DoubleLine, and goodbye for now.